Hi there folks, it's James Marley here, co-founder at Livewire Markets, and today I'm joined by Matthew Kidman, who's a portfolio manager and a principal at Centennial Asset Management and runs their Level 18 fund. Now Matthew presented at Livewire Live in 2024, and we're going to do a little bit of a revisit on his shocking prediction, as well as talk about how he's investing across the Level 18 fund and some of the views he's got on the Aussie market. Matthew, good to have you in the chair. Thanks for coming in.
Thanks for having me.
Now, when you host discussions, you always like to set the scene. So I thought I might do the same for our audience, just to take them back to September 17, I think it was, 2024. And your prediction was around bull and bear markets, a bit of a history lesson on structural bull and bear markets. And you drew on 103 years of data using S&P, I think it was, for the long run. And what the analysis showed was that the average length of those bull markets was 14.6 years. Now, at the time, we were 15 years and 5 months into that bull market. Now, one of the things that you said was you didn't think that markets were about to go to custard and turn upside down. In fact, you said you were very bullish for the next 2 to 3 years, which would be good for markets, but you were talking about the fact that we're late in a structural bull market. So let's start with that prediction. Has your view changed? Do you still think that we're very late?
Yeah, I think that view, it's easy to say now, and only time will tell whether we're right. And there's only one thing about predictions, James, is that they never turn out right. So you'd be wrong in some form or another. Yep. But history is a good guide, I think, and it's been confirmed over the last year as far as I can work out. So I was of the view that we hadn't, even though the average length of those structural bull markets, and we're talking about the US here because it's the biggest, deepest market and the best data you can get. The Australian market follows generally, so you've got to be aware of the US market and how it operates. So the average term was that 14.6 years. The shortest one of those were way back in the 1920s where we started the analysis, where we had 8.5, almost 9 years of a ripping bull market that led to the 29 crash, which is famous period in history and led to one of the worst structural bear markets in history in the Great Depression not long afterwards. So it doesn't surprise me that the bull markets go a bit longer than that because that was a bit shorter, a bit sharper. This one's a nice grinding upward market that's accelerating. And why I think it's playing out is that over the 13 months or so that we talked back in September last year, most equity markets around the world have actually appreciated quite strongly, and other asset classes too. So we can come back to that in a minute. But not only the NASDAQ, which is up 24%, and we had the great, Liberation Day tariff sell-off in the middle of that. We're still up 24% on the NASDAQ over 12 months. The Australian market, not as strong. It's up 9%, but the smalls, which we've talked about, the small ordinaries, up 20-odd%. European market's even better than the NASDAQ, 27, 28%. The German market, the Italian market, and who said Europe was dead? And even Japan's kicked along, done high teens. Equity markets are exploding all over the world, which happens at the back end of a bull market, structural bull market. And then people will say, well, hold on, there's other alternate assets, and obviously the big one at the moment, gold and crypto. Yep. Now, they're not going to save you in the end when it stops, because if they're stores of value, then they shouldn't be running now, because people are actually quite got a big risk appetite in putting it into equities. Yep. There's no asset class that's collapsing around the world. They're all going together. So crypto, we know in its various forms, Bitcoin being the biggest investment there, is a risk dial up. So when things run, it runs harder. When things come down, it tends to collapse over time, but reboots. Gold seems to me to be there's lots of reason people are investing in gold, but the idea that it's a safe haven, that it's a store of value, that doesn't seem logical to me at the moment. People are not buying gold on fundamentals. They're buying gold because they think it's going to go up and the other guy's buying it. Yeah. It's all in sync together and it's going up, which is classic bull market stuff.
You did say, whilst it was a bit of a bear market style overview, bear market coming, what you did say was you were very bullish over the next 2 to 3 years.
Yeah.
That's 13 months ago now. So does that mean that 2 to 3 now is down to 1 to 2? Like, where do you think we are in the progress?
Yeah, I think we're getting closer. It makes sense. I think 1 to 2 is not a bad. I think the next 1 to 2 years is going to be very good for markets. Interest rates are coming down slower than probably what we thought, but they're generally coming down a bit.
Direction's still there.
Yeah, so flat to down, very positive for markets. We've got the beautiful AI boom going on, which is fantastic because you always need a thematic. And it does, it accelerates activity. We've got all this CapEx going on, it's exploding all around the world, there's data centers. It's very good for economies because companies are spending, but you always need one of those themes where it's different this time. AI is going to change things forever, and it might well do, but generally markets are not different. They will go up and then they will go down. And I think it's the right time. As I said, asset classes are running, liquidity is pretty good, there's a lot of lending, and so I think, and economies are going okay, they're not too bad. There's the odd one that's not going too well, but the other thing is that governments are still spending. This idea of austerity, maybe only the British government's probably the only one that's really saying, well, maybe we can't spend too much. Everyone else is saying, yeah, we're going to bring our budgets down, but can't do it. Like we see in France, the US, the idea of Doge and all that, and then they put out their big beautiful bill and bang, there's billions and trillions of more money being spent by the government. So that's all positive, and I think the next couple of years is very, very good for equities.
I think you've probably mentioned a few of them already, but what would you say are some of the traits, the common traits of a late stage structural bull market that you can see today?
Yeah, well, we mentioned the AI one. Yep. Terrific. We need a theme that gets everyone very excited. I think that's the main theme. On the back of that for Australia is resources. You know, critical minerals, copper, great for Australia. Activity, like, it doesn't have to play out necessarily directly into the miners, but there's mining services companies that we play in. Yep. Going through a tremendous period. So it feeds through to the rest of the world, dragging everyone up. I think also the S&P 500, which is the main index in the US, is from the bottom in 2009. Now, I know everyone will say, oh, hold on, we've had 20% corrections along the way. Your garden variety bear market 20% is not what I'm talking about. I'm talking about the structural shape of the market. The market hit a bottom in March 2009 and has been effectively running in a band in an upward trajectory since then. And what will happen, I would think, if history's right, is it will accelerate and it will go outside that band.
Mm-hmm. So a blow off.
Blow off. We saw it here in 06, 07 when we had the stronger for longer mining boom. And then that was all derailed because of the GFC coming out of the US. We saw that in an article that you guys ran on Livewire, Paul Tudor-Jones. I don't like to listen to old rich guys because they're always bearish. But I had to say that the way he framed his bearishness was very good, that we're almost into the party mode of this structural bull market, and you've got to play it if you're worth your salt, but you've got to be aware maybe something on the horizon's not so good. I think that's a good way of summing it up for him. He was talking about a whole bunch of things that are running, gold and so on. So I think those signs are there. So the S&P's up about 600 odd % from that bottom. The 82 to 2000 bull market, that was a tremendous bull market that started with technological change around the personal computer that morphed into the internet invention and so on. That got about 750%. Obviously, the Nasdaq's become a bigger component. The Nasdaq since the bottom of 2009 has done 1,800%. It's done tremendously well. And that will accelerate. That will accelerate because the average S&P gain is about that 750, 800% in these structural, and we're here at 600 odd %. I think there's more to go, and it will accelerate. But there is something over the horizon we've got to be aware of, and that is maybe one. I don't see it happening by March. He made the point, Tudor-Jones, that in the last bit of the tech boom in the last century, 1999 October through to March or April when it fell over, the Nasdaq doubled in that last 6 or 7 months. I don't know whether we're at that stage yet. We're building towards it, so I don't see it falling over next March because here we are in October or April. But I can see maybe if we did a 30 odd % year on the Nasdaq, 30% on the S&P, this time next year could be the earliest where it falls over. My suspicion it's a little bit longer still. It's probably between 1 and 2 years that we'd start to get nervous.
Yeah. Well, let's take
valuations go through the roof. So that's probably a point I should have. Valuations are irrelevant in most markets. I know that it's contrary to what everyone says, but there's a valuation that you can set for a market for its earnings and where interest rates are. The market either trades below it or above it, rarely on it. And so we're above it. Now, you've got to be wary that, we're at 20 odd times on the S&P. In 2000, at the peak, absolute peak of the tech bull market, we got to 29 times. It only really matters post that, when everyone goes, holy moly, things are expensive. How have we got to this situation? In between, valuations are going to keep you out of the market when the market's still running.
Yeah. Well, let's take it from that big picture view. Talk about what you're doing with the Level 18 fund. You're typically a small cap investor. It's your preferred hunting ground.
Yep.
But you can move up the market cap spectrum. My take on that is, it's a bit of a defensive play, seeking out some liquidity. What does that look like in terms of positioning in the fund today? Are you more back down in smalls? Are you still got some of that large cap exposure?
Yep. So in 21, 22, when rates went through the roof, stocks came off, small caps got belted in Australia down 20%. NASDAQ in the US was down 30% in that period. We migrated to bigger caps. That was a better place to be. Today, big caps, and it's played out the last 12 months, very few opportunities there in Australia. In the top 10, it's hard to pick. You might get one or two, but you don't want to be overweight there. Yeah. It's a risk on market at the moment. So you want to go down into your mid and small caps. You've got to be careful with the micro caps, because when the music stops, you don't want a long tail of micro caps. You've got to selectively pick them, make sure that they've got a good business model, because there's going to be a lot of capital raisings in the next little bit. It's easy to collect stocks. Bull markets can be as dangerous as bear markets, because when it stops, you go, holy moly, how did I get into all these stocks? Now I can't get out of them. Yeah. But you do want to play in that mid to small cap market, and that's where we are. Now, we're not a big resources player, and so gold is booming, and a lot of people are doing really well out of it. That's not necessarily us, but there are a lot of other themes going on that suit mid to smalls. There's a huge defence spend going on in Australia, around the world, but Australia, we're the most exposed here. There's energy transition going on with a lot of the data centres and poles and wires being changed out for the transmission links. That's getting spent a lot of money, and there's companies doing really well out of that. There's obviously the mining that we talked about, and there's also an Olympics coming. Now, people underplay the Olympics because it's not in their face yet. But as of the middle of next year, contracts are going to be handed out, and it's going to be mainly southeast Queensland and in that bottom half of Queensland, that bottom corner. But it's going to put a lot of pressure on wages and so on. But huge amounts of spend coming in, and so you've got to be very selective about. You can't get caught there too much, but there are some opportunities about people who are supplying raw materials into that area. We think there's some fantastic themes, and we think the housing market in Australia is probably bottomed and is coming slowly off the bottom, but it's no longer been.
Housing construction, is that what you're talking about?
Yeah, housing starts. So we all know there's a housing shortage in Australia. There's enormous demand, but there's cost and price problems. So we think those cost problems for developers to make money out of building new dwellings is slowly repairing itself. And we are getting lower rates, so more people are coming into the housing market. So we don't think there's a boom in housing, but we think it's come off the bottom, will gradually improve, and that's a big part of the Australian economy. So we think there's a number of themes that make you want to be exposed to the domestic economy, and the best place to get that is in the small and mid caps.
Yeah. A couple of different ideas there. We talked about being smalls and mids. Maybe you could pick an example of a company or a couple and step me through your process for getting a stock from an idea, from a ticker on a screen into the portfolio. What's the process you run it through? How does it go from being an idea to getting a position in the fund?
Yeah, so we do it the hard way. We don't follow an index, so we're going to come up with ideas all the time. So we'll put together a portfolio of 40, 45 stocks with a weighting of 1% at the bottom, up to 5% of the portfolio. How you get to 5% depends on conviction, but also liquidity. You can't put your tinier stocks at your bigger stocks, and we're generalists, so we'll construct that. So we've got to go and find ideas. So if you go back a couple of years, you'll read a lot, you'll talk to a lot of people and discuss things and say, okay, there's a data boom going on around the world. How do we find something? So there's obviously the data center operators in the smaller end. There's Macquarie Technologies and so on. There's some other players in that area like Southern Cross Electrical, but a lot of them have been discovered. So then someone said to me, well, what about SKS Technologies? And I said, well, that's been a terrible company. a commercial electrical company out of Melbourne. All they've ever done is make $1 million 1 year, lose $1 million. It's capped at 30 million. Why would I invest in that? And then when you went and spoke to them and said, look, we've taken a lot of costs out and data centers require a lot of work from electricians. So you talk to the company, then you go and talk to a competitor and they say, yeah, that's right. And so there is work there. And then you work out the margins are better in that. And you say, okay, then you've got to decide how big a position you take in this, because the catalysts are starting to unfold, the balance sheet's good, cash flow's good, all the fundamentals are good, and then you've got to work it out and you let it ride. So we found SKS, it was a $35 million company right at the bottom of our market cap. Yep. And we ran that all the way through. Today, it's got a market cap of it's gone 10 times.
Wow.
It's been terrific.
Is that your first 10 bagger?
Yeah, probably. Like I've told you before, I've never had a 10 bagger, and I reckon SKS is as close as I'm going to get, because you do trade around in it a bit as you go up.
Yep.
So the first share you bought, if you held it the whole way, then you get it. Today, it's hard to comprehend because a lot of the good news is baked in, and it's not that big a company. They've done a fantastic job. You asked me who are some of the great managers. There's Matthew Jinks and his team down there who took over a few years ago, have done a tremendous job of capturing this opportunity and executing really well.
Yep. Okay. Have you got another one?
Oh, I can go through a few if you want.
Well, just to bring the process to life a little bit for us, yeah. Maybe just give us one more.
Okay. So one that we've been in since the bottom of COVID is a company called SRG Global. Yep. And SRG Global has been an interesting journey, because in the old days, it was more of a mining services company. It still does that, but it's a tiny part of their business. Then they went and bought into or merged with another company in Perth that was basically a developer, a property developer that did specialised work in that area. And that was, market just said, we don't like this. What are you doing? And they spat it out. Get to the bottom of COVID in 2020. Everyone said, too hard to give you a forecast. So SRG had been through this terrible merger. The market had given up on it. The new guys, David McGeorge and Roger Lee, came in, and I talked to them and I said, I can't believe it, you're giving us a forecast for next year. No one else is doing that. How do you do that? And they go, oh no, we've got all the work contracted and we're getting a lot of work. Okay, all right, so I know the business, I've watched it before. And slowly but surely, they've morphed that business, and they'll tell you, into a more recurring revenue where they provide a lot more maintenance and a lot more engineering services on assets over multiple years. Mm-hmm. So they've gone from this kind of one-off mining and construction company to something that looks like it can tick along each year, and they start each year with most of their revenue locked in. And
investors love that, don't they?
They love it, yeah. But they're doing the right thing. And those guys, I can't remember what it got to at the bottom, but today it sits at $2 and maybe it was 30 cents all those years ago. And the thing that tweaked me on it was, this is the only company I can find that's giving us a forecast. What is going on here? Because no one else is. The biggest companies, Woolworths weren't giving you, or Telstra weren't giving you a forecast. They all said it's too hard during COVID. We don't. And these guys came out and said, we can grow this year. I can't remember, it was something like 15%. And this is an EBITDA range of 15 to 16 million. They went, wow, that's remarkable. So different ways you can find companies.
Yeah. Now, if I think about investing in a bull market, the bullish side of my brain says you want to make as much of that opportunity as possible. Yep. In your fund, you've got the ability to hold weights of cash and the ability to do some shorting as well, which can overall reduce your net exposure to the market. Mm-hmm. Numbers you've given me over the history of the fund, 85 to 90% net exposure.
Yeah. Where
does that number sit today, and is there anything to read into it?
Yeah, so we've been at the absolute bottom of COVID when we were the equivalent of 90% cash. Because we didn't know, that was very short-lived, it only happened over a couple of, we didn't know what was going on. So that'll give you an idea of how hard we work to make sure we don't lose money. Yeah. But on average, we'll be that 85 to 90% long. We might have one or two shorts, and it's important here and that everyone knows that we only short sell bigger companies. We're generally a small cap investor, and the reason is small caps, you don't want to be known as a shorter in that market, but it's hard to borrow, expensive. But we do come across some good big cap ideas that can make you money. So good discipline. So we keep it that. where are we today? We're at about that 90%. We always like to have a little bit of cash because opportunities or capital raisings and the like in companies we own or we've been looking at. There'll be floats.
Yep.
Now, we won't take every float. There's a lot that don't work, but we'll take some that come along that are attractive. So you want a little bit of cash, but in bull markets, we'll be 90 to 95% long, no shorts. Yep. Shorts at the moment are hard work. You might come across one or two that's very specific to that stock, but it's easier at the moment not to be short. So yes, there is a window on where we think the market's at. We think there's positive times to come.
And on that IPO, you talked about new listings. You'd have your ear to the ground. What are you hearing? Is the pipeline starting to bulge a little? Are you getting is the phone ringing?
Yeah, it's both seasonal and structural at the moment. So equity markets, everyone said were dead because too expensive, we don't want to be listed. And that's still an element of truth to that. But as prices gone up, guess what? People selling the assets go, oh, I'll get the best price on the share market. So they're coming back. There's definitely a list. We think there's 5 or 6 lined up that we can see, maybe more, between now and the holiday period over summer. And there's that seasonal component where they try and get them in before the end of the year, because then everyone goes on holidays and reporting season. You haven't really got a shot at until March next year. So I'd expect there'll be a lot of listings, floats, capital raisings the next month or two. And we're starting to see it, yep.
Yep. Nearly everyone makes money in a bull market.
Yep.
I'm starting to hear it about, from my wife, everyone's starting to get into the game. Making money in a bear market, a lot harder. What's your playbook for staying afloat and making money through a bear market?
Yeah, well, there's all different varieties of bear markets. So there's the garden variety we talked about, 20% correction. We virtually went through one earlier this year with the tariff scenario.
Yeah.
We went through one 3 or 4 years ago with interest rates spiking. We went through one 5 years ago with a sell-off in COVID. But they all recovered very quickly as a whole. Then there's the structural ones I'm talking about, much harder, where returns are bad for years on end. Like we're talking about 15-year cycles where it's difficult to make money. And they can present themselves in different ways. Some will just beat you no matter how good you are. So an 87 crash style, where the US collapses overnight, the Australian market opens 20% down.
Not much you can do.
Not much. You basically had to be bearish beforehand. Really hard to navigate that. Then there's the GFC style, where over 16 months you went down 50-odd%. Grinding, also quick at times, but always felt sick. No one was going to go in the market. You can manage that a lot better. Obviously, we can go to cash. Now, then people say, well, hold on, I don't want to be anywhere near the market. Why would we give it to you? The reason why you want to keep it with us in that period is because when it does hit bottom, the first 6 months out of it is the best 6 months. The first 6 months of a recovery after a huge fall like that is better than the last 6 months that we're going to go through at some stage on this run. They're the 2 best periods. It's the top and tail, but it's the first 6 months it bounces. And once again, really hard to capture because it happens overnight. And you regularly hear in these bear markets that someone will come out and say, well, we hit a bottom in October, we hit a bottom in March, and here you are 6 months later and go, I don't feel it. And then you look and the market's up 25% from that bottom.
Happens without blinking, doesn't it?
Yeah, and that's another one. Then there's the one that I've experienced, which was the tech wreck in 2000. That was my first one. 2000, everyone knew things were frothy, valuations high, things were floating, just had business plans and no revenue. And then I don't know to this day what ticked off why that market fell over. That's the one that's a mystery to me. There's no obvious catalyst. But in the US, where it was most buoyant, a bit like the AI is now, the S&P gave up 40% over 2.5 years. It was a grinding down, down, down. And people just go, I remember reading what's the longest bear market in history, and people were losing money, people left the industry. And I presume it was a bit like that in the 70s when you had a long grinding bear market. So every bear market's going to look different. How you make money in any of those, you've got to play what's in front of you, but you've got to play what is presented to you. So there will be rallies in bear markets. So if you've got to be on the long side, if you're really sharp, you'll get hold of those rallies, but they'll give up after a while. There's also, you can go to cash, protect your money, and you can also short sell stocks. The people who are going to do really poorly, people without flexibility, and they're going to be, unfortunately in Australia, they're going to be smaller cap managers. They won't have the flexibility and they'll freeze. They won't know what to do. It happens every bear market. They just go, I just can't look at it. The people who do okay on the long only side are normally the big cap guys who can be more defensive.
Yeah.
You can invest in Telstra. It might be down 10 or 15%, not going to be down 50. You know, that's how they think. And then there's the people like us who should be more nimble, who, you know, in our fund, to give you an idea, because we've got that flexibility of cash and shorts and whatnot, we're long most of the time because we know markets go up. So you don't want to, but our analysis tells us we only capture 31% of the downside of any fall.
Yep.
So we'll lose your money, but if the market's down 10%, on average we'll be down 3.1 because we've got those levers to pull. We can go big cap, we go defensive, we can go to cash, we can short. You know, instead of just being long only, which is good 8 out of 10 years on average, but it's not good for the other 2 years. And so we will arrive at that point, and we've got to deal with it.
Yeah, I'm going to come back to the cycle in a moment, but I know you love the stories and learning about the companies, the people behind them.
Yep.
The stories of the company, the stories of the people as well. And for those of you out there, I recommend you check out the Success and More Interesting podcast hosted by Matthew, which we help put on some great stories of fund managers and corporate CEOs. But
Thanks for that, James.
That's all right.
You got it in.
But for today, I was wondering if you could maybe share, I know you named one earlier, but a management team that you think is executing exceptionally well right now.
Yeah, so I think the SRG guys have done really well. We mentioned their name. They've done a great job in transforming that company. But there's so many at the moment, which I'm impressed with. So one of our bigger investments over time was Zip. Now, the whole market's in Zip now. But if you go back 2.5 years, it was on its knees. The model didn't work in the US. And then, so Cynthia Scott there and her team, she came in, revamped that business, did a terrific job. The guys at Codan over in Adelaide, sleepy old Adelaide.
It's been around a long time, that stock, hasn't it?
And it's been an up and down stock. It started as a telecommunication stock. They got into gold detection. Effectively, they've gone back to telecommunication, but evolved it into a more industrial business. And once again, transformation. So Alf Ianello and Michael Barton done a tremendous job over there. Really worked their balance sheet hard, moved the business. One that you know well, Grant Hackett, who was first episode on the podcast.
Yep.
And his team down at Generation Development, they've really evolved that business. Tremendous stuff. So, you know, that's another good one. Like Lee Mackinder at ServiceStream, he's been through a few ways, but really good. There's just a whole host of Ian McCown, another guy another guest we had on Success and More Interesting Stuff, running Pinnacle, done a fantastic job over time.
He's almost managed to defy the cycle a little bit with that business, hasn't he? Where active fund managers have been under so much pressure and he's gone the other way.
Yeah, they've had a bit harder time more recently around index changes and that. But what Ian has nailed, that most of those funds management groups where they take, you know, businesses and they take positions in them, what they promised you they do is improve your distribution. We'll raise you money, and guess what? They do it. They do it better than anyone. So Ian's done a great job there. So there's lots. There's just lots, and I mentioned Matthew Jinks down at SKS, and it's been a very bright patch of very good managers over time.
That sounds quite bullish. Matthew, I just want to finish. This is a question. We had Victor Schvetz from Macquarie come and speak at Live by Live. You got to interview him on the sidelines. His view's been published pretty widely on our platform and a few others, and he was talking about this time it is different with the rapid rate at which companies can enter markets, crush moats. He also talked about abundant liquidity crushing cycles. Now, we opened this discussion with a view effectively that we're coming towards the tail end of a bull market, and a bear market will hit us at some point. He was sort of saying bear markets will get knocked out.
Yep.
What's your response, or what's your take on what Victor had to say?
Yeah, look, Victor's a lot smarter than me. He is an exceptional thinker about markets. But I think he was telling you, if I can just distill his conversation and all the other commentary we've heard from, I think he was telling you that is a scenario that could play out. But if the policymakers and the reserve banks around the world get it wrong, it could be a disaster. And I think The one thing that really worries me about that cycle scenario, that cycles are no longer relevant, is that I think the backstop is what he's talking about. The backstop is because we went through the GFC and then COVID. The reserve banks around the world have got the playbook on how to get through a disaster or an external impact on the markets that trigger selling off. And that is basically, printing money in various forms, quantitative easing, as we got to know, all these subjects.
Slashing rates.
The Japanese kind of pioneered, but could it be applied more broadly to the North American, European, Australian economies, and slashing rates, printing money, putting everything to the side for the moment, not worrying about inflation because things are collapsing, getting things back and afloat, pump liquidity in. So I feel that most people who have been around for a period now think there's a backstop. And that's the backstop, that they'll be forced to do it, and therefore, as Victor says, the cycle gets muted. I worry that there's a complacency around that. And I think he does as well. I think he's telling you that it can be all right, but guess what, if there's a misstep, and he talked about 30% unemployment and markets correcting savagely, and if we do go into a structural bear market, not one of these corrections that last multiple years and maybe more than a decade, something like that is some variety of that or version of what he's saying is going to happen. And that's going to be very hard for everyone. And I think people should be aware. Like I say, I'm bullish at the moment because all the signs are that way. But there will be a period, history tells you will be a period that something goes wrong and we enter one of these structural. The way the markets are set up when that much debt, and I think Paul Tudor-Jones said it as well, what brings things undone is always some form of leverage. And I agree with that comment. GFC was about company and bank leverage. Tech wreck was probably about consumer leverage in the US. This time it could be government. I don't know. You don't know what triggers it. But I think that's what Victor was saying, and it's different this time. It's always different, but it ends a similar way. It's always where you go back and say, I didn't see that coming. It's different, but guess what? We went from a bull market to a bear market. And I'm happy to come back on when it does or doesn't happen. But I think at the moment, you just stay long, but you stay close to the market and just be aware that something could go wrong. And the next time it does turn down, just be very aware that it could last quite a long time. That, we're at 09 to now is, what have we got, 16 and a half years now? We're a year and a bit on. 16 and a half. The 42, 43 to 65, 66 was the longest, and it was in the low 20s. So it can go on, but I suspect the longer it goes on, the nastier it'll be on the other side, unfortunately. Oh. But for the moment, stay long, be bullish.
Make hay while the sun shines.
Yeah, I think Paul Tudor-Jones was saying that. I think Victor is saying that. But Victor's a strategist at Macquarie. He's got to tell you things are good generally, but he's telling you if there's a slip up, things could go very wrong.
Well, I'm going to take the bullish tone out of that rather than the bearish
No, I am
tone.
bullish. I'm not telling people to run yet.
Thanks for coming in, Matthew. And as I said to you, out there to you, listeners, check out the Success and More Interesting Stuff podcast. I put a link in the show notes. Thanks for coming in. Appreciate your time.
Thanks, James. It's been fun.
I hope you enjoyed that chat with Matthew Kidman. He's the Principal and Portfolio Manager at Centennial Asset Management. And remember, check out our YouTube channel. We're adding fresh content just like this every week.